I'm Charlotte McLeod with investingnews.com, and here today with me is Nick Hodge, publisher at bizarroworld.com. Thank you so much for being here. Great to have you once again.
A pleasure as always, Charlotte. Thank you.
Yes, of course. We are catching up on our last conversation all the way back in November, so things are looking a little bit different. I thought we could start with gold and silver. You'd said at the time we were in the middle of a precious metals bull market. So where would you place us now?
Yeah, I mean, that was probably a pretty accurate assessment then. If it was back in the October-November timeframe, we ascended into January and February. The conferences in Vancouver in the early part of this year were quite euphoric, and as we all know, gold went above 5,000 and silver went to 120 thereabouts, and are now in corrective mode. I think a couple of things have changed. You had a wanton war that started that drove people into quasi-fear mode that drove assets into the dollar. The dollar has been quite strong since the start of the war. You have a U.S. dollar index, a DXY index that's over 100, in fact, closer to 101, whereas in the early part of Trump's second term, you had a dollar that was weakening, and of course that weakening dollar made commodities and assets and gold and silver more expensive. Whereas now a rising dollar and also rising bond yields precipitously, in fact, on the U.S. 10-year going to nearly 4.5%, have driven the precious metals down. So you're getting a correction inside of not just a precious metals bull market, but you're getting a correction inside of a commodity super cycle that I believe started around the 2020 timeframe. So not to get away from gold and silver too soon, but lots of other commodities, and not just hard ones that you drop on your foot, but soft commodities that were rallying as well. Corn and wheat and things have started to come down. I think it's temporary. Maybe we can talk about the Fed for a second. You had a new Federal Reserve chairman come in Kevin Warsh that was billed as a dove. And yet in his first meeting, he sort of had to, my partner Gerardo called him a dove in hawk's clothing, right? Because he sort of had to say, like, we're willing to combat inflation, because you have an inflation number now that's over 4% as a result of that war, essentially, and then the rising oil price that inflated things elsewhere. So the main number on the CPI was 4.2%. I think you'll see that start to come down pretty dramatically. You've seen oil sort of fall off as we come to a close on the Iran war. And I think that'll give the Fed cover to, if not cut, then at least soften its stance over the next 6 to 12 months, which will give you a resumption of the rally in gold and silver and other assets that are priced in dollars.
Well, I think that's a great overview of the situation. There are lots of directions for us to go. I was going to ask, I think investors have a lot of questions right now about how they should play these lower gold and silver price levels. So how are you looking at it right now, assuming it's a buying opportunity?
I do several things, as you probably know about me. By now, having done these interviews for a number of years, I have like a long-term safer portfolio that I manage, and then I do the speculative things. So like Rick and like some other folks in the space, we were taking some profits. I'm talking about the safe side now. We sold some like GDXJ, for example, and some GLD, so taking some profits off of the producers and the metal itself. We did that last October. We did that again in April, so filled the cash coffers a little bit. And then over the past couple of weeks, as we head into the second half of the year, we've been redeploying into some of those funds. We've been buying more GDXJ, for example, as it fell below $100 for the first time in a while. That includes many of the large and mid-tier producers. We've also been buying royalty companies on the safer side of things. We've been buying Royal Gold. I think there's lots of royalty opportunities out there, whether it's the Francos or the Wheatons or some of these smaller companies that are around that have done deals even with some of the larger crypto companies. So those are the two safer ways that I'm playing the gold sell-off, if you want to call it that. And then on the speculative side, I haven't done too much, to be honest. We wrote a fair amount of checks into private placements in 2025. I think we did 10 or 12 deals. So far this year, we've only done 3 or 4 deals, so the pace has slowed. One, because a lot of companies did raise money over the past year, so there wasn't as much need. 2, I think the bullish overall gold and silver environment, despite the sell-off of the past couple of months, has brought outside capital into the space, and so the terms weren't as favorable. Whereas we were funding companies at cheaper valuations last year, we were getting better terms in terms of price and in terms of warrant coverage. Some of that went away, where you're not getting as long duration warrants or as well priced deals. So we've sort of slowed our roll a little bit on the speculative side. So I mean, that's the honest answer to what I'm doing right now.
Yeah, no, I think that's very helpful. And I'll ask you one more question on gold, then we
Yeah.
can move on. Is there a particular factor that you think could kick off the next like higher? Would it be that turnaround from the Fed into a more dovish stance like you were talking about?
Yeah, I believe that's what most people are watching, and I think that's what will catalyze the next rise higher in gold. You had a lot of fear that this inflation was going to be longer than transitory. We remember last time inflation was going to be transitory, and it lasted much longer than anyone thought. In this case, it truly is, and will be, I believe, I can put it in those sort of terms, transitory. I think that the June and July CPI numbers will be below 4%. You'll see them coming down from above 4% that they were in May. And again, you've seen that sort of in the bond yields as well, going back to the bond market. The 10-year has started to come back down a little bit. I think that bond yields have peaked. The 2-year was rising into those higher CPI numbers, which normally, if not predicts, maybe is a call for or reflection of what the market thinks or wants the Fed to do. But that's been softening a little bit as well. And then if you look at the probabilities on the Fed side of things, like on the CMA, you can see that they've sort of been very murky or unclear. Like they were pricing in a couple of rate hikes by the end of the year just a few weeks ago. And then as we came into this conference, it was sort of neck and neck by the December meeting. Like last time I looked, it was like 43% chance of doing nothing or 46% chance of a hike. And then there was like some smaller probabilities for other outcomes. And that has confused the market. And I think as we get later into the year, as the market gets more comfortable with the way the Fed chairman talks, because what the Fed chair says matters. We just had the death of Alan Greenspan recently, and he was sort of the first Fed chair that did the Fed speak thing with irrational exuberance and all that stuff. And so, we might not like the Fed. We might think it shouldn't exist. We might not like what it does, but ultimately, it does wag the dog of the market. And so I think Kevin Warsh will start to soften his stance. I think you'll see the Fed doing nothing or in fact cutting, getting more priced into the market. And I think that will rekindle the fire underneath the gold and the silver prices.
All right. Well, I always love to hear about gold and silver, but we'll leave them there for now. During that November interview, you had mentioned it was actually between copper and uranium as your top pick for 2026. So we'll check in on both of those,
Sure.
maybe starting with copper. Any surprises with its performance this year?
I mean, no. If it was picked as the top pick, it's certainly been that. I mean, you've had copper go to all-time highs, well above $6 a pound. Lots of folks are talking about shortages. You've had continued supply-side problems with mines being offline from some of the larger producers because of seismic activity or flooding activity or other sorts of activity. And you've got the continued build-out and deployment of capital from the large tech firms into the build-out of these data centers. I think at the last quarterly reports I saw from like Meta and Amazon and Alphabet, they're going to spend something like $700 billion this year on data centers. And we all know the backstory of how much copper that needs. The interesting factor on the copper side of things is that, well, there's a couple of interesting factors. It has come down a little bit, but it hasn't come down like the other commodities and precious metals have come down. That tells you there's a real supply-demand backstop. But there's a wild card that your listeners should be aware of, and that's the Commerce Department report that is yet to come out. This time last year, July 2025, we had a real scare in the copper market. In a single day, it was down more than $1 a pound because, as I'm pretty sure I was reading the news article in this hotel a year ago, Trump was going to do some sort of tariff thing, and then he backed off the tariff thing, and instead they initiated what's called, and they did this in uranium 5 or 7 years ago, a Section 232 investigation, from which the Commerce Department was supposed to give the president or the executive branch a report in 1 year's time, which is now. The report hasn't come out yet. I've been looking every day, Googling and seeing if it's come out. So we're waiting to see what that says. And if you read Bloomberg and you read these other outlets, the outcome, because Trump is involved, is sort of uncertain, right? They say he could do tariffs, he could not do tariffs, he could do nothing. So, it's like we don't know what he's going to do, and that could be the wild card. So I would be watching that for opportunity. Like, if you would have bought that volatility last summer when copper went down $1 in a day, that would have turned out pretty well. And I think the same thing with the tariff scare, back to the Rose Garden event in early 2025. These are short-term blips caused by an erratic a president or a doublespeak president that have turned out to be long-term opportunities. And I think whether and no matter what that Commerce Department report says, and no matter what Trump's reaction is, you should be watching it for volatility because the long-term trajectory is still going to be higher.
Yeah, that's a blast from the past with the copper news from last year. I do remember being here as well and just ripping up some of my questions,
Right.
being like, we've got to talk about that. For copper, the only negative that I ever really hear about it is that it's tied to the economy. So, any concerns there in terms of copper and the connection to the economic outlook?
Yeah, I mean, Dr. Copper, right? And they say that's sort of about South Korea as well, Kospi, which is the index there, Kospi and copper being the doctors. And both have softened marginally. I just talked about copper a little bit. The South Korean market has started to roll over a little bit, but it's been on absolute fire. The South Korean market has been blowing away the S&P, and both are near record highs. But the Kospi is up something like, I don't know, 60 to 100% over the past year, driven by some of these chip maker stocks. So by that measure, and pulling back copper from just the past couple of months, I think the economy is healthy. I think you're due for a slowdown in growth over the next couple of quarters because the economy is going to have to digest the higher oil prices that just came, right? So $120 oil makes manufacturing and production more expensive. It causes the consumer to slow down when they've got to pay $4 or $5 for a gallon of gas or diesel, and that's going to flow through the economy. So whereas we were just printing 3 or 4% growth in quarterly GDP terms in the U.S., you're going to see that slow to 2 or 1%. But I don't think that's a long-term factor. Like, I'm not calling for a recession. I'm not calling for negative growth. I'm just calling for a slowdown as we digest the inflation that we just had, which comes on a lag. And then I think post that, going back to the Fed answer I gave you about gold, that will flow through the economy and we'll get back to growth sometime in 2027, Q2 or Q3, something like that, after we digest a little bit slower growth. So, yeah, growth can slow down in the short term, but I just told you the big tech names are spending $700 billion deploying the capital for the build out of data centers. So I think in the longer term, 3 to 5 year time frame, we're still well on track for a copper bull market and a prolonged supply deficit.
All right, so nothing economically drastic like we sometimes hear
so.
about. All right, let's talk about the uranium opportunity as well. I think the main thing I'm hearing about uranium right now is that term prices are rising, so that's positive for the sector. I do think some investors have been frustrated that there hasn't been more upward momentum for stocks. So how are you seeing it?
Yeah, the stocks have frankly been soft. They've sold off from their highs last year and earlier this year. If you look at one of the main ETFs, URA, for example, it's been down and to the right. And this comes at a time where the fundamentals, at least as I see it, have rarely been stronger. Like, we started healing all our wounds from Fukushima. All the things that have needed to happen have happened. We've seen the headlines from the restart of Japanese reactors. We've seen them want to, in fact, build new reactors. I could go through the checklist, right? We've seen the tech companies partner with utilities to, in some cases, revive plants that were, the former site of scares, like 3 Mile Island is coming back online in Pennsylvania. We've seen the extension of reactor lives, even in Democratic states like Diablo Canyon in California, and Kathy Hochul, the governor of New York, saying that they want to increase and extend the lives of nuclear reactors there. We had a goal in the U.S. to celebrate our 250th birthday of getting 4 small modular reactors to reach criticality by July 4th. That happened. So you've got 4 small modular reactors online, paving the way forward for that sector of the uranium market. All sorts of things have happened, Charlotte. The government announced in the past 2 or 3 weeks they're going to offer $17.5 billion in loans in conjunction with Cameco and Westinghouse, which is, I think, something we discussed 2 or 3 years ago in New Orleans. And that's going to help solve the chicken and egg problem. It's like everyone knows we need nuclear. It's safe and it's stable and it's baseload and there's no carbon emissions, but it costs so much and it always takes longer and there's cost overruns and nobody wants to sort of jump out and lead. In this case, you've got the government saying we're going to help backstop some of those funding problems. So if there is cost overruns or no one wants to, put the cart before the horse or whatever analogy you want to use, this will give some confidence to the sector to say, let's go ahead and start deploying capital. Let's build some new nuclear reactors. And even your Canada came out in the past couple of weeks with a 10-year plan saying they want to start building some nuclear reactors by, I think, 2035 was the date. And so the writing is sort of on the wall. As you mentioned, the contract price, I think, is up around something like $90 or $95 a pound of uranium. The spot price is lagging a little bit, 85 or 86. And sort of the same as copper, like the long-term supply-demand fundamentals are intact. And we're starting to see new supply come online. Like if you look at UEC or you look at Energy Fuels or you look at Encore, like these folks are producing uranium again. It's coming back online in the United States. And they're going to have to fill their pipelines. Like they've all been doing deals. I guess a little bit of chest pounding. Like Encore just announced that they've got final approval from the federal government to bring Dewey Burdock online. Like that's an ISR asset in South Dakota that we funded in a company called Azarga. That my folks made some 700% on when Azarga was taken out by Encore, for example. And so it's been a long time coming in the uranium bull market. We've been players in it for some time now. You and I have talked about it for a while. There's been fits and starts, but the backdrop fundamental case has never been better. And so I think it's a pretty good buying opportunity given the pullback you've seen in the related equities. Oh, and maybe one more thing, I suppose. Sorry to go on a rant. The fuel companies are emerging as an interesting space as well. Like you've got Centrus, and there's a couple of other like isotope players. Some of these small modular reactors, they require different fuel than the standard pelletized fuel that we're familiar with that Centrus makes. And there are some other companies working on those fuels. So it's not just the uranium explorers and developers that present an opportunity this time around.
So just a little more patience needed for this one.
Yeah, or maybe not even patience. So you should probably be acting now, and then patience for it to pay off.
Right,
yeah.
right. Okay. I think that's a great summary of uranium. It felt like we hit on all the main points that are behind it right now. We are here at the Rural Symposium, and I know that your presentation topic is going to be private placement. So before I let you go, I wanted to ask a little bit about that. I think people probably know the merits of private placements, why they should consider it. But what do you want people to take away? Why do you think more people aren't doing them?
Yeah, well, I think that a lot of people meet the requirements of what is an accredited investor to be eligible to do them. This is sort of a high net worth audience. I've talked to lots of business owners, lots of manufacturing company owners, retired chemists, retired doctors, pilots. Like these folks are accredited investors, even if they don't know it. I also saw Rick ask in his opening talk how many first time folks were here, and lots of hands went up. And I think that people aren't aware of the way these early stage resource companies fund themselves and get started. A lot of them might be meeting these companies for the first time out in the exhibit hall here. But by the very nature of that and by the metrics that Rick uses to invite people to this conference, they already have to be in his accounts to be able to exhibit here at the show. Well, how do you think those companies get into his accounts? Rick's not out there buying in the open market. He's doing private placements, and he'll say as much oftentimes on stage. That's drinking upstream from the herd or getting to the green grass first. So you're coming into these companies either at their formation when they're just becoming public, or because they need to fund some catalyst. They're going to do a drill program or they're going to do an economic study. Well, they need capital to do that because they're not producing anything. By and large, most of these, I'm talking about the explorers. So they need to raise capital, and that comes from strategic investors, the likes of Rick Rule and Michael Gentile and Eric Sprott, for example. Like these folks are writing checks and private placements and collecting warrants. You can do that too if you get access to deals and if you meet the standards to be an accredited investor. And so we just went through a lot of the why, like why copper, why gold, why uranium, and there'd be a lot of time spent on that on the stage. We're $40 trillion in debt, the central bank is buying. Like we hear that again and again and again. I'm going to focus on the how you should be investing in these companies, and it's by getting in early on the food chain, being perhaps a larger predator. Again, I'm starting to mix my metaphors, but basically buying these companies early, ahead of them funding the catalyst, before they're spending that capital to tell their story via channels like this or via the exhibit hall. You want to fund them ahead of that before other folks start to learn about them, and private placements are typically the way, at least that I found in my past 20 years, to do that.
Yeah, absolutely. That makes a lot of sense. Well, I will send you back out onto the show floor unless you had any final thoughts that you want to leave investors with.
No, I think that the summer is a great time to do due diligence, to get familiar with the companies. There's a lot of active drill and exploration campaigns going on as the summer exploration season unfolds in the U.S. and in Canada. And so it's a bit of a quiet time with softening in prices to get positioned and get familiar with companies that you can invest in that will be having results as we head into the fall.
All right. Well, I think it's a nice place to wrap it up. Thank you so much for coming on to talk about what's going on in the markets. This was great.
I appreciate it. Thank you.
Of course. And once again, I'm Charlotte McLeod with investingnews.com. And this is Nick Hodge with bizarroworld.com.